We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Radio. I'm your host, Tom Bodrovics. Joining me today is Jeff Clark, founder of goldadvisor.com and the author of the new book, Paydirt. Thanks for joining me today, Jeff.
Tom, it's great to be back with you. Thanks for having me.
Excellent to have you back. It's been a while since we've spoken. And of course, there's been plenty of changes in the world, in your world, in my world. But you've just come out with a new book called Paydirt, in which you help walk both the seasoned investor and someone who knows nothing about the space through gold and silver miner investing. So what pain points did you see within the industry that you felt like you could address with this book?
That's a great question, but the first reason I wrote the book is because a lot of people were asking me as I started revealing more of my personal picks, like, well, how did you pick this stock? Why did you pick that one? Why did you not pick this one? And you can't really address that, on a tweet, at a conference, maybe a little bit in an interview, but there's no follow-up. So the idea of writing a book came up as to try to address, and help people that were really genuinely wanting to know how to pick a mining stock and why I picked this one or didn't pick the other one. So, at the time I felt like I was too busy. And then COVID hit. And of course, we couldn't go anywhere or do anything there. So I started outlining what eventually became Paydirt. So it was a long process, about 2.5 years off and on. But the first version was, it was good, but it was just this big data dump. Mm-hmm. So I felt like, there's a few books out in the industry and they're good. I've read them, I've bought them, but I felt like I wanted to make something that someone could sit down and read and actually be very engaged and maybe not even put it down, be able to put it down, which sounds strange for a mining stock book, right? How could you say that it's a book that you're not going to be able to put down? But I did try to make it more engaging, more entertaining, and that sort of thing, and easy to read, simple, very straightforward. We hired an editor. He said, Jeff, what you ought to do is put some other people in the industry in the book as well. And I had not seen anybody really do that. So there are 16 other people in the book, other experts that really contribute some very strong advice about what to do. And the thing I realized in interviewing them, Tom, was they were very specific about what to look for and what to not look for. Look for this, this, and this. If you see this, exclude it. They were very specific. There was no hemming and hawing, no vague guidance. And so the book will tell you exactly what to do. It is written for someone who knows nothing about mining stocks, but would like to learn how to pick them. But there's so much meat in the book, if I can, say so, that I think even a seasoned investor is going to find a lot of really good tidbits and insights that they can use immediately once they read the book. So it is a fun read, but that's how it came about.
Yeah, I like the way you put it together because there's a lot of, as you say, quotes from other people, kind of lessons to solidify what you're talking about. And I found it personally very to the point. There's no filler and fluff. And as you say, you're able to digest a lot of that information. So, Jeff,
yes.
Why is the mining sector so attractive to you? And what gains did you see that seemed to be accessible to you that drove part of your passion in this space?
That's a great question because the junior mining sector is one of the few remaining sectors that consistently has, or at least offers, the opportunity for outsized gains. And that's exactly what you can get if you catch the cycle. And I believe we're on the cusp of another cycle now. But if you catch the cycle, there are very specific strategies you can use to make sure you capture the biggest part of that gain. So what attracted me is I am kind of a little bit of a gold bug. My dad was a gold prospector. And I've been in the industry a long time. I like it. I like gold. I like owning gold. I like mining stocks. But there's an important distinction here, if I could veer off for 1 second. When this cycle goes into a mania, and I believe that it will at some point, I will not hesitate to dump my stocks. I will be selling them for huge profits, what I believe will be huge profits. And I won't hesitate to do that once we go into some kind of mania. And we're obviously far away from that. And I have specific indicators I'm looking for that. But even though I like gold, I will not hesitate to sell, because that's how you lock in profits. That's how you become part of the wealth transfer. So just that aside, that knowing that even though I may be a gold bug, I'm not going to be afraid to sell, and I'll hold my gold until the monetary system is revised. So it's not sustainable. I think we all know that. There's been dozens of interviews just from your guests that have pointed this out. So, I'll hold gold until that happens, and then we'll see what takes place at that point. But the idea is that I'm, even though I like it and love it, I'm not going to hold it forever, and I will sell my stocks for big profits.
Mm-hmm. I think that goes towards one of your points in the book of that you're going to date them, not marry them, right?
That's right. That's exactly right. Yeah. They're girlfriends. They're not wives. So,
so Jeff, there's so many different commodities and even metals that are in demand in the world. So why focus solely on gold and silver with this book?
Because for whatever reason, I think rightfully so, people love gold and silver. Investors love gold and silver. It's exciting to see, a new discovery. That's the reason we have this saying, there's no rush like a gold rush. That's been around for decades, for a long time. And that's because it's exciting to people, a new gold discovery. I think it goes back to people instinctively know in their gut that gold is money and silver is money. So I think that's part of it as well. But I think there's a little bit more excitement there. Gold and silver stocks tend to get a higher valuation than, say, a copper stock or a uranium stock or whatever. Those are going into bull markets too, though. But I think gold and silver, have that special attractive nature that people like, and that gives them a higher valuation, which means you get a bigger return.
And is that valuation more so at the peak of a cycle, or as the cycle is heating up, rather than all points of the cycle?
That's a good question. I think we're at the beginning of a cycle, and if you look at where the gold price is and relative to where like the junior stocks are, there's been no catch up yet whatsoever. Tavi Costa just put out a report showing the vast gap between junior mining stocks on the venture index and the gold price. And just to match where they've been before in the last cycle, the junior stocks would have to rise 286% just to get to fair valuation with the current gold price. And of course, the gold price over time is going to go higher, potentially a lot higher. So there's enormous potential with the mining stocks right now, just in a catch-up phase. So that means the opportunity is still there. So if you need to refine your portfolio, trim it up, maybe add a couple new ones, something like that, this is a good time to do it, because that opportunity will not always be available. So I think we are at the beginning of the cycle, and when we get to the top is when someone who hates gold and makes fun of it, calls me and asks for a gold stock tip.
Yeah, that might be a really good indicator.
Yes.
So, Jeff, do you have the same amount of, let's say, experience with gold and silver? And which of those two metals holds more of your attention from an investment perspective?
Well, they both do, but for different reasons. Again, going back to the idea that they're money as opposed to, copper or aluminum or whatever the case might be. So it's kind of going back to that. I own gold because it's more stable, it's less risky. Silver is the schizophrenic cousin that's going to be dormant sometimes and react maybe even violently in its price at times. So you hold them for different reasons. I think there's opportunities in both. So I like holding both. I really do.
How do you separate the world of, let's say, metals investing? Should somebody that's interested in the sector just dive into only mining stocks instead of, let's say, maybe the less exciting gains of physical gold and silver?
Well, that's a good point, because neither one of them are investments. Gold and silver are money. They should be viewed as money. And if you've never held a gold coin in your hand, one little ounce has got a little bit of heft to it. And I think you instinctively know that this is money. This is real, so gold is again, the wife, and the gold stocks are the girlfriends, gold is less risky. It has no counterparty risk if you hold it yourself. It is your hedge against what's coming for the future. But we're not in it to make money, necessarily. We're in it to hedge our portfolio, and this is the time to be overweight gold, given everything that's going on in, society and the economy and markets and all that. Whereas the mining stocks, they're not investments either. They're speculations. You are speculating when you buy a mining stock. Even if you buy Barrick or Newmont, the biggest ones in the world, you're still speculating. It's not an investment. It's not something. It's not an heirloom. You're not going to leave it to your grandkids. So you are speculating, and it's important to pay attention to the cycle, which is one thing we point out in the book. And given that we're near the beginning of a cycle, this is a great time, like I said. But there's other factors you should be looking at in terms of what you want to own, and that comes down to you as a person. What kind of person are you? What kind of investor are you in terms of your risk quotient, your financial breadth, if you will? Your emotional fortitude comes into this. So there's a lot of things to look at to determine what you might want to invest in. But I think having exposure now is critical, I would say.
So Jeff, maybe if you could, let's go through some of the, let's say, the guidelines to determine what your appetite might be to be a mining stock investor. What are some of those personal dynamics that you kind of need to have in order to be able to participate or participate while being able to sleep at night in investing and or speculating in mining stocks?
Yeah, so the way you sleep good at night is owning a meaningful amount of physical gold that's directly under your control. That doesn't necessarily mean it has to be in your house. If you're someone in the public eye like me, you don't want it in the house. So I have no gold in my house, so don't come knocking on my door. I actually have a fake stash of gold coins back here. They're fake. So, if somebody comes, I'll give them that. So, but gold is what's going to help you sleep at night. And I think it's the mining stocks, of course, that are going to give you a multiple on that gain when you speculate with them. So am I on track with your question?
I was asking more so, what are some of the, let's say, personal traits that make somebody a good fit to be able to stomach investing in mining stock or speculating in mining stocks?
Right. So sleep at night with gold, but the mining stocks are going to be much more volatile. And it is not unusual to see them drop 20% in a day. So what you have to be able to do is understand that. If you understand the volatility, if you understand the risk, and you have the emotional maturity to accept that, which is not hard to do. You just have to realize you're in a very volatile and risky sector. So understanding what you're investing is important, but understanding that, hey, I'm going to see a lot of volatility. Some of that volatility is going to be down, but volatility is not necessarily risk. Volatility can be an opportunity. In fact, it's volatility that is going to potentially make us a lot of money, right? So as they move higher and get overvalued. So if you're able to stomach that, if you're able to accept that, I think you can be a mining stock investor. And I can give you very specific strategies to follow to help you identify what potential winners will be, as well as reduce your risk.
So, stepping back a little bit, Jeff, where do you think we are in the cycle for gold and silver prices in general? You know, many people have come into the sector in the last decade having been promised massive gains only to not have them materialize as of yet. So in your opinion, have we missed the bottom, or as Rick Rule says, are we setting up to take that big meaty chunk out of the middle of the move that you want to be a part of? Is that still ahead of us?
Oh, absolutely. That's still ahead of us. We haven't seen any real big move at all in mining stocks. Again, going back to that chart I mentioned from Tavi Costo, you know, mining stocks, the juniors have to rise, you know, almost 300% just to match the current gold price. So we've not missed it at all. That's still ahead. So I think focusing on that and getting ready for the next cycle is important. In the book, I show all the different cycles that gold has had. Mm-hmm. There are very distinct cycles that the gold price has made. There's over, I think, 8 or 9 of them now. You know, since the 1970s, they're very clearly laid out. You know, big gains giving a lot back, big gains giving a lot back. I also show a similar cycle for the gold stocks themselves. So the point is, they do cycle. The last upcycle was sort of a mini cycle from the COVID bounce, if you remember that. I missed the boat in 2011 and 2013. So in terms of you know, capitalizing on that to a maximum degree. So I promised myself I wasn't going to let that happen again. So when 2020, during the COVID crash happened, I was very aggressively buying silver, I think twice, gold once, and I bought just an oversized amount of gold stocks. And, you know, I went 5X that year. My entire portfolio went 5X. And then it pulled back, you know, after September's peak. So I ended the year up 4X just on that little bounce. And that was a minor bounce. That was, you know, historically speaking, that was a minor bounce. Since then, we've been in a down cycle. So guess what happens next? You know, historically speaking, there is another upcycle coming. We've maybe started that already. But I think instead of trying to predict the next cycle, when it's going to happen, you know, how big it'll be, et cetera, just prepare for it. Mm-hmm. Instead of focusing on predicting, focus on preparing and make sure your portfolio is ready for that in terms of the amount of physical gold and silver you own and the mining stocks that you want to have. And keep some cash too, by the way, because there's always going to be new opportunities that come up. I just announced a new pick yesterday on our site. So there's always going to be new opportunities. So make sure you have some cash too. But the bottom line is the next upcycle is coming and it's our job to prepare for it. And given everything happening in the economy and markets, like we were saying, you know, this could be a big one.
Mm-hmm. So, you know, you mentioned a couple of those last little spikes. And of course, there was a good run in the mining stocks in 2016. Is there some of that context that is important for us to understand and maybe some lessons that we can learn from that time period that apply today?
That's a great question, Tom. And I have numerous examples of Paydirt in the book. But 2016 was another big spike. And just referencing the book real quick, the average producer rose 264% in 2016 during that short spike. The average junior rose 321% during that spike. And that all occurred within 7 months. Very similar to the COVID bounce. Mm-hmm. That in 7 months, just from the stocks. There's also some examples from other experts that are in the book. They said they shared the kind of gains they got from that time period. So that's just yet another example of a cycle in gold and silver where if you're prepared, if you're invested, you know, you can make some very big gains.
Mm-hmm. You know, Jeff, as the metals get more expensive, as their prices go up, that also drives up costs on the other side of it for the industrial uses of silver, for example, with their rising costs. So how much do you think of that side of the demand equation from those industrial users of the metal could drop off due to substitution for other metals?
No. No, the exact opposite is happening. First of all, the amount of silver that goes into these products, what's a critical metal, there's not a lot that goes into it. The most silver that's used in an EV battery right now is 50 grams. That's the highest. Mm-hmm. The average is lower. So you have roughly 1.5 ounces in an EV battery. So if the price of silver goes to 50, is that really going to change the cost of a $50,000 car or $75,000 car? It goes to 100. Is that really going to change the input cost? No. And you find that similarly in other industries as well. The amount of silver that goes in isn't that great. You're looking at 1 to 3% of the actual product for the amount of silver that goes into them. Some are higher, but it's not a lot. So the price of silver doesn't really change a lot of that in most cases. In terms of replacement, and that's why they don't have to focus on replacing silver. And just the opposite is happening. Chen Lin has done a lot of research into this. He's actually read some of the documents coming out of China written in Chinese about their solar demand. So the solar demand there, because of the technology and how valuable silver is, they're actually using more silver in their solar panels, for example. Mm-hmm. They're also coming up with double-sided panels so they can capture more sun, morning sun, afternoon sun, so they can rotate. There's, more silver in that kind of product. So there's actually more silver going into it. And I don't think we have to worry too much about replacement costs. If silver goes to $100 and stays there, that'll spark some replacement. But the point is, silver can't really be replaced and have the same conductivity as something else. Silver is more valuable than most other metals for the purpose it is being used for. So in some cases, they can't really replace it, or they'll have to make the product bigger because they're using other heavier metals, whatever the case might be. So I'm not too worried about that right now.
So, you bring up a good point of the photovoltaic cells and demand for those. Does that just mean that industrial demand on its own is only growing out into this next decade as we see this greenification of how power is generated and how many more electronics are being produced to be able to capitalize on that power as well?
Absolutely. If you want to go green, you will automatically have to go silver. Go green means you're going silver. So it's that simple. Silver is used in a lot of the technologies that are growing right now and being demanded right now and being pushed right now for, green purposes. So there's more silver that's coming out. Industrial use is going to grow. It is growing. And some people will look at it like, well, it's no longer a monetary metal. Well, at some point, the industrial use is going to get to a point where maybe it does capture most of the demand. If you look at a chart from going back 30 years ago, the amount of industrial demand for silver keeps rising. The percentage of its use, the percentage of its demand keeps rising over time. But that's like a barge in a port trying to negotiate a 3-point turnaround. The silver price is a speedboat whipping around that in the meantime. So we are still going to see, silver spikes in the future for monetary reasons. It's just going to take a long time for industrial use to overtake the monetary use. But it's going to grow, and it acts as a support for the price. So it's very exciting to see what's happening to the silver industry.
Mm-hmm. Another piece, I guess, to discuss when it comes to energy was, part of the industrial uses for silver. And one of those uses that surprised me was the use of it in the manufacturing process of nuclear fuel rods. And this was really interesting to me, considering kind of the combination of two of the materials that we often cover on the show. So how much silver is typically contained within a reactor that has fuel rods in it?
It was surprising to me when I was researching the book and looking at the uses of silver that I came across. The nuclear industry uses silver in their control rods. So from the book, I can tell you The amount of silver in a reactor can vary, but the average reactor contains 20 individual rods, which amounted to about 56,000 ounces of silver in 2019. So the nuclear industry is only going to grow. The demand is going way up. The amount of new plants being built is probably going to exceed the existing amount of plants we have by 2030. I don't recall the exact date, but next decade. So there's going to be, nuclear is going to use 100,000 ounces of silver each year just for that one industry, even though the amount of silver in each control rod is actually pretty small. So it's kind of interesting. All these, new uses for silver are coming up, and that's contributing to greater and greater demand industry for silver.
Mm-hmm. So as a contrast to this demand picture, Jeff, as the price of the metals continues to appreciate, for example, gold seems to be hovering around $2,000 US per ounce. Does that make more low-grade deposits start to become more economically viable, or do the bare costs like diesel fuel also grow somewhat proportional to the price of the metal?
Yeah, that's a good question. It depends on each company and each deposit as to how that will affect it. But one thing we can look forward to is that deposits that were sitting there that may have been uneconomic, even at $1,800 gold, are going to become economic as the price moves higher. Again, that assumes that the price outpaces the cost of constructing and operating that mine, which, of course, inflation has impacted greatly. So it depends on each deposit. You have to look at each one separately. But generally speaking, yes, it's going to make some deposits economic. So those stocks will probably do well once it's announced that they're economic now. It will depend on investors believing that the higher gold price is sustainable. Because if they don't believe that, if sentiment isn't stronger, they may not want to buy those stocks. So we will need sentiment to be stronger and the gold price to appear like it's going to be at a higher level on a sustainable basis.
Mm-hmm. You've included a good amount of information from geologists in the book to help illustrate different points of the book, many of whom I've spoken to as well. So, Jeff, what are some of the most important lessons that you've gleaned from some of the most successful geos in this space?
It was interesting because I love the idea of including them. So I spent all last summer interviewing them, and I learned a lot. I learned things that I didn't know before. I'm not a geologist, but I've learned a lot over the years. But even interviewing them, I learned a lot. I did put a lot of geologists in the book for a reason, so that people can understand, okay, this is what this means. This is what that means. And again, it's very specific, like you said. So I think people can benefit from that. So I think the main thing I learned was they were very clear on what they look for. It was great to read. So I really trimmed down what they said and just captured the real essence of what they were trying to get across. But that's the biggest thing I learned was they're very specific. They didn't always necessarily agree, but they usually did. And it was great because it makes it easier for me and anyone to determine, okay, this is probably a pretty good speculation versus, take that one off your list.
Mm-hmm. I think one of those lessons that many of them would probably agree on is to try and find gold where you've already found gold. Do you think that is, fairly accurate of a lesson, or let's say a theme throughout all of what they said? Absolutely.
That's the game Battleship. Remember the board game as a kid where you're sticking things and trying to sink your opponent's, battleship, well, when you had a hit, where did you go next? You didn't go way off here. You tried to hit near there. And that's exactly what a brownfields project is all about. We know there's gold here. We know there's silver here, whatever. So we're going to look for more. And it's not just looking for more, but it's applying modern techniques, because a lot of these mines were, dug by old timers, so they never went deep, or the drilling goes back from the 1980s and we didn't have geophysics then. So you can apply a lot of modern techniques to these areas and potentially find a big deposit. And so I focus on that in the book, and there are several companies in the portfolio right now that are doing that very thing.
Mm-hmm. Jeff, what's the Lassonde curve, and where do you try to focus on investing in projects along that cycle?
So the Lassonde curve is just a couple big humps like that. I think many of your viewers are familiar with it, but the beginning is a very early stage project that has nothing, and they make a big discovery, and the stock price spikes, sometimes very dramatically. And then the price cools after that big discovery and goes back down. Even if they continue to report good drill results, you won't see the stock necessarily continue to spike. In fact, it might continue to weaken. There are many examples of this. And then you begin, if it's going to be, looks like it's going to be economic, then you begin the development process for, permitting, developing, feasibility studies, engineering, a lot of that. And frankly, a lot of that is boring. It's not exciting to an investor. It doesn't tend to move the stock, so the stock can be flat for a long time. Excuse me. And then as it nears production, that begins its next spike higher. There's a re-rating for the stock because there's excitement building about a new gold company, a new gold deposit or operation, a new silver mine. The excitement builds, the stock gets re-rated. That's the second big hump. Mm-hmm. Sometimes, believe it or not, that second hump doesn't match what the discovery phase price was because there's so much excitement over discovery. But one of my favorite strategies in the book is that pre-production sweet spot, where it's going to get re-rated as it nears production. Excitement builds. That's exactly the strategy that Lobo Tigre, who I think you've interviewed, has mentioned a lot and has researched more than anybody else. So that's almost predictable. Buying a high quality stock a year or so before it's going to be in production. But there's very specific guidance in the book on when you buy, when you take profits, and et cetera. So that's the Lassonde curve, and it can give you some very big hints about when to invest and when to take profits. That's just as important.
Mm-hmm. Yeah, it seems like that first down leg of the cycle is the very capital intensive part, where after the excitement of that new discovery, they have to prove the rest of it and then go through the boring process and the time consuming process of permitting and, actually building out the logistics to be able to mine that first ounce, right?
Yeah, that process can be long too. It's, we're talking at least 3 years, in some cases 5 years or more. Mm-hmm. But there's a couple of stocks I have in the portfolio that I own that are in that boring phase, but it's because they're good deposits, they're big, or they're high grade, pro mining jurisdictions, and they may be bought out. So there are some good reasons to potentially look at stocks in that development phase. Plus, they're a lot cheaper then too. Mm-hmm. So.
Yeah, exactly. So, Jeff, are these companies that are nearing production the only place to invest, or do you see opportunities in many other parts of this life cycle of metals companies?
Yeah, that's a good question. That is my favorite strategy because it's fairly predictable, but you're not going to get, usually a 10x return from that particular cycle. You're going to get, a double in 12 to 18 months. Mm-hmm. And again, it's almost very reliable. So that's why I like it so much. The problem is there's not that many opportunities in that particular phase every year. Mm-hmm. And this excludes the barracks of the world that are existing producers that are adding a new mine. It's not that, it's the single asset producer that's going to start a new mine for the very first time. That's what you're looking at. The biggest gains are to come from that discovery cycle. And you may have a good example would be Snowline Gold last year. Despite with a weak market, mining stocks doing very poorly, that stock went 10, 11x for me last year. It's since pulled back, but that's a good example of a stock that makes a discovery and is in that Lassonde curve, and the stock spikes. So you can get very big returns there. Now, the risk obviously is higher. but I show you how to reduce that risk. Pardon me, in the book. I do like to invest in that cycle. That's what the guy holding the gold nugget in my logo in the background there. That's what it's kind of all about, is making that discovery. But there are many companies that have made a discovery and they may have a small resource, but it looks like it's going to get much bigger, or it looks like it's going to become a mine, or it looks like it's going to get bought out. So there are a lot of opportunities even that are less risky. If you have a stock that already has a resource, a company that already has a resource, that's less risky than, speculating on a greenfields explorer. So there are still many opportunities, along the way of that Lassonde curve.
Mm-hmm. Jeff, is there something, about how much exposure that a company has? Let's say a company that is easy to identify, that comes to everybody's mind, that's in that, pre-production sweet spot, almost the trade being crowded, if you will, that plays a role in how attractive a company is to you. Are you looking for a company that is more unknown, ideally, to be able to invest in?
Well, they're probably known because they've made a discovery. They've been around for a while in development, and they've announced the construction decision. That's when you want to make sure you buy and own the stock. Again, there just aren't that many opportunities for that every year. But if you use the screening process that I outline, again, it's very clear. Let's say there's 4 companies one year that are, in that phase, and maybe 2 of them are good, and so you could buy them. So yeah, I don't know if I'm answering your question or.
Mm-hmm. So, Jeff, do you like the model of royalty or streaming companies as well, considering they have far less overhead and operating expenses than an actual mining company?
Yes, I like them. I don't own a lot at present, but that's only a function of who I am. I'm looking for, discovery or expansion of resources, because I think I'm going to get a bigger return on that. That's why I'm kind of like, Babe Ruth at the plate. I'm looking for home runs, but I am going to strike out more. Mm-hmm. Royalties give you that option of reducing your risk dramatically, and they're well known. And for that reason, they always have a higher multiple. So I show in the book, like, here's a good, framework for looking for valuations on royalty companies. The problem is they're always overvalued. Even in down cycles, they've been overvalued. So you are going to pay a higher multiple normally, mm-hmm. for a royalty company than you will for even a producer or something, that's made a discovery. So they are going to have a higher valuation, but I don't think you should let that necessarily scare you off, because they've always had a higher valuation. Just make sure you're getting ones that have, strong royalties, that they've got an NSR in the whole property, not just a portion of the mine. And of course, that they have mines coming online soon. They're going to pay them royalties. That's kind of their sweet spot, right? If you can find some that have a lot of royalty income that's going to kick in the next year or two, that could be a good buy.
Mm-hmm. So, Jeff, what are some absolute deal breakers to you in the world of gold investing? Are there ETFs that you don't like? Are there, bad jurisdictions? Are there certain share structures of companies that you need to watch out for? What are some of the real red flags to you that would completely take something off the table?
Well, that's a good question, because once in a while, I'll see or hear about, this great drill result, and it'll get a lot of attention on Twitter. Did you see this drill result? And it's good. But if I don't know the company, the first thing I'm going to do is not analyze that drill result, but it's going to find out, okay, where is this and who's behind it? Mm-hmm. If it's in some war-torn part of Africa and it's being run by a guy who last ran a marijuana company, I'm not really that interested in it. And so I just don't go any further. Those are deal breakers for me. It's got to be in a pro-mining jurisdiction. And by that, I mean a strong pro-mining jurisdiction. I tell you who I think they are in the book. Now that it'll shift over time, right? Peru used to be really good for silver. Now it's in question because of everything happening down there. So I'm not saying I wouldn't invest there. I'm saying that's one thing you need to be aware of as you're evaluating companies. So those things are very important to me, and I need to have strong leadership experience, and they have to have successful experience. I need to be able to go back and look at the last company they ran and look at the stock and how it did under their tenure to see if they created shareholder value. If they did, hey, that's great. If they didn't, I want to find out why. It doesn't mean it's automatically necessarily not an investment. It does mean you need to find out why.
Mm-hmm. So, Jeff, how do you think about structuring a portfolio of mining stock investments? As investors, we really need to have a plan, a framework for investing and discipline to stick to those parameters to help us capitalize on this cycle. So do you try to split your portfolio into certain parts that weigh out safety, upside potential, and or leverage?
Yes, but again, I think the answer to that comes back to who you are as an investor, your risk profile. Do you understand you're speculating? Are you okay with the volatility? Do you want something that's more stable and safe? Do you not want to worry about stock picking at all and just buy an ETF or a mutual fund? I don't buy them just because, they include the bad with the good. I think I can outperform an ETF. So it really does depend on who you are as a person as to how you want to structure that portfolio. I do give some help with that in the book. I'm not trying to push the book so much, but I do help with that in the book because it is an important question that you're asking, and you got to understand who you are and what you're investing in. That's the key.
And I think even, something as simple as somebody's age can play a role in that, right? Whether you're looking at capital preservation, building alpha, there are, as you say, different parameters for every person that you need to deliberately tailor your portfolio to, right?
Yes, but I would never tell a 70-year-old don't ever invest in mining stocks because maybe they want to take 10% or whatever of their portfolio and speculate with it for some outsized gains. That's a good opportunity right now, given where we are in the cycle. So age doesn't play a role in it, but it plays a role more in who that person is and how much net worth they have. If a 70-year-old has zero net worth, they probably shouldn't be investing at all in mining stocks. So it really comes back to a lot of different factors and what that person is able to handle, what they are able to do financially, emotionally, and that sort of thing.
So how about when to buy and sell, Jeff? These are obviously where the rubber meets the road in terms of actually making money. So do you have you come to build some rules for yourself around how and when to get in or out?
Yeah, that's a great question because you have to sell and take a profit to realize a profit, right? So I do have the 5 commandments of mining stock investing in the book. And I do say that chapter is just as important as anything else that someone's read in the book, because you have to have some discipline and you have to know when you're buying and you have to know when to sell. The short answer is when the reason you bought the stock in the first place has played out, well, that's a time to take profits or sell depending on the circumstances. If you've got a double, that's a rule for me personally. It's not a rule for everyone. And some of the other experts in the book give their rules for when they take profits. But when I get a double, I just automatically take profits. Now, if it's really running, I'll let it run for a little while, but I'm going to take profits. But I'm going to leave a portion of my investment there to see how high it goes. So there are some definite rules that you want to follow that will help you really maximize your profit. You can't be afraid to take a profit, but it doesn't mean you have to sell entirely. I think that's one distinction people should be aware of. Just because I take profits on something doesn't mean I'm selling out entirely. I still want to see what this stock can do, what this company can do, and there's still reasons to hold it.
So, Jeff, what are some other great resources that you use for reliable information within the industry. We need to be able to base these decisions that we're making, these speculations in many cases, on hopefully credible information. So what are some of those sources that you find to be invaluable?
I would say, first of all, get the book Mining Explained by Northern Miner. That'll give you the basic. It's not the most exciting book in the world, but it's not real long. And it tells you everything about the full phase of mining from discovery to production. Make sure you get the latest edition. They update it frequently. I think it's on the 22nd edition or something now. So make sure you get the latest edition. That'll give you a good base. Mm-hmm. And then, get a good book on mining stock investing. I can think of one in particular you might like. But the other thing I would say is just talking to people in the industry. And by that, I mean geologists, CEOs, finance people, other analysts, things like that. Getting that kind of input has been very valuable for me, because then you can weigh it against other things that you've learned. So it is a learning process. Mm-hmm. There is a learning curve to it, but boy, if you can take the next year and just devour everything about this industry, you're going to be in a very good position to profit.
Mm-hmm. Absolutely. Well, there's so much more that we didn't touch on that's in the book. Mm-hmm. Like, as you said, the commandments, let's say the 6 Ps. There's all these great lessons in the book that I highly recommend. Why don't you tell our listeners where they can get it, Jeff?
Yeah, the other thing I would say is the book's not real long. I really tried to make it as tight and concise as possible. So there's a lot in there, but it's not real long. So it's not going to take you, 3 months to read it. But it's on the site, thegoldadvisor.com, and you'll see a tab for Paydirt at the top. And I have several videos there that talk about the book. There's a free sample chapter about the scariest mine I've been in. And if you're claustrophobic, fair warning.
That was a silver mine in China, right?
Yeah, that was a mine in China that I'll leave unnamed. But everything I say in that chapter is true. It happened. So we don't have a physical book yet. It's a digital book only. It's a downloadable PDF essentially. I made it that way because I could keep the cost down. You can read it anywhere. You don't have to lug around a physical book. It also has active links in it if you want to see, get the latest Fraser mining report. You can download it right there. There's also newsletters I recommend that offer me a discount to readers, so you can actually get a discount off subscriptions with that. So you don't get all that in a physical book, right? But I know a lot of people wanted that, and so we are in the process of doing that now. I've got a little interruption coming up here with back surgery, but that process is underway. I have other people working on it. So it will be available in physical form at most outlets, Amazon and Barnes & Noble and all that. So that's coming. Unfortunately, we will have to raise the price a little bit just because there is some cost in doing that. Mm-hmm. And of course, Amazon and all those guys want their cut, and they take the lion's share in a lot of cases. So unfortunately, we do have to raise the price a little. But a physical book is coming. You can get the digital book now right on the website.
Excellent, Jeff. And of course, that's at thegoldadvisor.com. And of course, your Twitter address goes by the same name, at The Gold Advisor. Jeff, I want to thank you so much for your time today and wish you the best with your back surgery coming up here pretty quick.
Yeah, thanks a lot, Tom. This was great. And yes, I will be back.
Excellent. Thanks, Jeff. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.